Hello, everyone. Thank you for taking the time. This is slot number 1 of our monthly market session, during which we aim to review what has been going on in the past few weeks in the beautiful space of B2B software and technology. And let's kick it off for today. Beyond providing you with overall updates with our usual plan, we have a new guest today with Siyi. Many of you have met Siyi, for those of you that are going deep on the platform and working with us in project mode. But for those of you that don't know Siyi, Siyi is a mastermind of our coverage on the data and intelligence thematic. And Siyi will provide us today with a bit of a perspective on what we've seen going on in the space overall. But first, before we dive into this, let's move to the next page, Ray, with a quick overview of what has been going on in terms of performance and market action. And here, as usual, thank you, you will see what has been going on in our basket of just over 250 listed B2B software and technology companies in North America and Europe. We try to understand market action. So this we are looking at the month of April on the top end of this slide, and you can see year-to-date performance below. Quick news for April: it's a month of bounce back across the board for software and technology. For the wider indices as well, you can see S&P 500 and Nasdaq up 10 and 15% respectively. You can see that technology has been a beneficiary of this rebound across. And there is a bit of a nuance when you look at things from a weighted or non-weighted perspective. If you look at our universe across, it's up 5%, so it's trailing wider indices. The basket of companies that have been performing exceptionally well in terms of rebound are the majors, so they had been hit very severely in the months before. Well, those have been actually bouncing back very strongly, up 18% on average in that cluster. If we de-zoom on year-to-date performance overall, you can see wider indices 5-7% respectively, S&P 500 and Nasdaq, that's at the bottom left. You can see that our B2B software universe remain in net negative territory so far this year, almost minus 19%. But then again, if you look at things on a weighted capitalization perspective, you can see that we are actually neutral positive. This is because the majors have been more defensible than the smaller cap type technology companies. To help shed the light on where we stand overall, I will passing on to Iñigo to have a look at valuation levels based on where we are now. Over to you.
Thank you, Ben. Yep. Thank you, Ben, and hello, everybody. So moving on to the next slide. As we look into the valuations, we did see early signs of stabilization in April, with EV sales multiples ending the month at around 4.2 times, which is slightly above last month's 4.0 times. That said, in line with what Ben said, valuations still remain well below the 5.6 time multiple at the start of the year, and it is below the long-term average of 6.6 times, with current levels last seen around Q1 of 2017. So when we look at the 4-month zoom, it also highlights that after a sharp correction throughout Q1, April was the first month where multiples broadly flattened. And we see a similar trend in the lower panel for EV EBITDA, where multiples declined from 20.4 times at the start of the year to 14.9 times in April, which is in comparison to 14.1 times last month. Now, moving on to the next slide. Despite that broader correction, the market does continue to differentiate strongly based on growth. So the fundamentals remain quite the same. High growth companies still trade at a clear premium at 7.3 times versus 3.8 times for mid growth and 3.0 times for low growth companies. However, it is also important to know that all company cohorts are down year to date, with high growth companies at around 30% negative. Moving on to the next slide. The same trend applies to the rule of 40 companies. And as always, for the B2B software universe, we calculate the rule of 40 based on revenue growth and free cash flow margins. In comparison to this, rule of 40 companies stabilized at 6.9 times in April, although it is still down roughly 27% year to date in comparison to our rule of 20 and then below 20 companies, which are trading at roughly 3.2 times and 2.9 times respectively. Moving on to the next slide, since May 2023, a revenue growth has traded at a premium relative to free cash flow margins. And although that premium peaked at around 77% in 2025, it's now compressed to 29% in April 2026. So implication here is that while growth does remain quite important, investors are already increasingly prioritizing profitability and also just quality cash flow generation across the board. And we look at that at the regional aspect for our North American and European valuation in the next slide. North American software companies continue to trade at a premium versus Europe at 4.9 times versus 2.7 times EV sales today. However, that premium continues to be supported by the typical stronger growth you'll notice in North American companies, which is around 12%. But that valuation gap has also quite narrowed modestly. So when you're looking at the premium, it's declined from around 90% in December to 81% today as European growth expectations begin to improve from last year's 3% to around 4% for 2026. And finally, looking at the macro side in the next slide, as always, we've seen these software valuations continue to show at a negative correlation with our US Treasury yields. And when we're looking at headline consumer price index, it rose sharply to 3.3% in March 2026, which is high rise from 2.4% in both January and February. And this is driven largely by a spike in the energy prices, which followed the outbreak of the Iran conflict. However, it's also important to note that the core inflation outside of energy, so this remained relatively contained at 2.6%, suggesting underlying inflation pressures outside of energy are still broadly anchored. And against all the geopolitical backdrop, both the Feds and the ECB have kept the rates unchanged at their most recent meetings in April. So that's it for the valuation segment, and I'll be passing it over to Siyi to talk more in depth about data and intelligence.
Thank you, Iñigo. Ray, if we can move to the next slide. So thanks, everyone. Very happy to spend several minutes to talk about data and intelligence segment today. Ray, if we can move on to the next slide, maybe. So this is a segment we have been covering over the last 3 years, and that includes both sector agnostic data providers such as ESG, sales intelligence data, as well as the sector specific areas such as financial data, legal, aviation, etc. So first, how do we define data and intelligence segments? Overall, we define it as companies that collect and aggregate structured data sets and provide such data access to customers mostly via subscriptions or API calls today. These might be, there might be adjacent analytics or workflow tools that are provided in conjunction to make the data usage more better materialized along the user journey, but data stays as the key value proposition of these companies. So when we look at the deals in 2026, while we saw deals across different data verticals, we especially saw active deal flows in the financial and market data segment and company and people data segment. Within the financial and market data segment, we see big integrated platforms looking to expand its proprietary data sets, especially private market data, which has always been considered as more scarce, less structured, and requires special relationships-driven access. And here we have the examples of S&P acquiring With Intelligence, MSCI acquiring PM Insights. And secondly, on people and company data, which is typically related to B2B sales intelligence or identity verification use cases. So this is considered a segment with higher disruption risk of LLM. Vendors are trying to hedge against that, especially by bringing the convergence of identity, buying intent, and contact data, and then strengthening the workflow synergies. Here we see the examples of Xperia acquiring ad data, Intensify acquiring Salutary. What's also interesting to note is that strategic deals dominated the deal flow as the incumbents continue to defend its own data moat. The fundamental logic is that first, it's very key to have acquisitions to build or maintain its proprietary data capability, which is a dominant factor in our AI first world today. And on top of that, we have strong synergetic AI-enabled workflows and the further expansion of scale of data, such as geos or time series. And these are considered as compounding factors to further strengthen vendors' positionings, which are another force that are driving incumbent data vendors' strategic acquisitions. And lastly, we want to highlight that proprietary data ownership is highly important when investors are pricing the assets. So it creates a clear divide with examples like with intelligence, Tigers, flight radar that were valued well above 10 times revenue multiple, while the others at 3 to 6 times. But of course, the other factors like growth and competitive positioning also play an important part of this equation. Then moving on to the next slide, knowing that maybe the next one here, I won't be spending time because we already covered it, mainly to highlight that the AI world today really shows that proper data is the clear divide of a vendor's leading capabilities or not, and the other factors mostly considered as compounding factors. Then I want to highlight that knowing that financial and market data is a key segment of the data intelligence market, we have recently launched a survey which covered around 100 financial institutions across hedge funds, private equity, asset managers, sell-side broker dealers. And without going into length to cover the whole survey, we thought to share like several highlights from the survey. So when it comes to the customer's tech stack, more than half of the respondents indicated that they use more than 20 vendors. But more than 60% of the respondents also indicate that the intention for data stack rationalization and consolidation is there over the next 3 years. And despite that, most customers, this is more than 60%, admit that apart from having integrated data platforms that provide multiple data types, such as Bloomberg, S&P, Refinitiv, they also need to retain some niche data vendors on top to complement the data insights that they have. However, still, more than 20% of the customers indicated that they want to consolidate over one single data provider as much as possible. And this is really aligned with the strategic deals we have just seen that are led by the largest financial market data platforms out there. And when we look at the budget evolution indication, the integrated platforms also seem to be better positioned than niche vendors, with the larger portion of respondents indicate more than 10% budget increase over the next 3 years, while having lower portion of respondents that indicate flat or even downward budget evolution. However, this does not mean that the niche data providers do not have space to emerge and grow, but rather what we see is that these data vendors with novel data sources or proprietary data, better quality or more real-time data continue to emerge. And increasingly, what we see is that these niche data vendors, they also leverage the integrated data platforms as their distribution channel. And over time, these vendors, of course, could become the big strategics could become natural options of exits for these niche data vendors. That will be all for the data and intelligence segment. I'll pass it over to Julia to look at the wider deal flows in the B2B software world.
Thank you, Siyi, and hello, everybody. So now looking at the deals side. First, on the P side, it has been a quiet start since the beginning of this quarter and actually of this year, 2026. Perhaps just 2 deals worth mentioning are first, Learfield, which is set to be acquired by TPG for an estimated $2 billion. And Learfield is a sports media technology and data platform providing sponsorship management, ticketing, licensing, and fan engagement solutions across the US. A second deal worth mentioning is iConsult, which is set to be acquired by Bridgepoint. iConsult is an identity and access management service provider, and we have been seeing a little bit of activity in the cybersecurity space overall. Let's go to the next slide, please, Ray. On the corporate M&A activity, on the other hand, it has been quite active, with total deal amount, number of deals, and average deal size doing well in this first month of the second quarter of 2026. Here, the two deals worth mentioning today are first Brex. So Capital One announced that it has completed its acquisition of Brex, which is a modern AI-native software platform offering intelligence finance solutions that enable businesses to issue corporate cards, automate expense management, and make secure real-time payments. And also the company leverages AI agents to help customers automate complex workflows to reduce manual review and control spend. So overall transaction value of this deal is of 4 billion euros. And the second deal worth mentioning is HCSS, the Nemetschek Group, a global leading vertical provider of software solutions for architecture, engineering, construction industries, announced that it signed a definitive agreement to acquire heavy construction system specialist, so HCSS, from Thoma Bravo. And actually, Nemetschek will hold approximately 72% of the shares, and Thoma Bravo will hold approximately 28% as a minority shareholder. And overall transaction value of this deal is of 2 billion euros. And if we go to the next slide, on the VC side, we see that VC funding has normalized so far in Q2 2026 as mega AI rounds cool down. However, two AI rounds contribute to the 10 billion euros deal amount so far in Q2. Anthropic raised an additional 5 billion euros, and Wave, an AI for autonomous driving, raised another 1 billion euros in a Series D investments. So that's it on the deal side. Just wanted to mention as well that we have not seen any IPOs in software and tech for now, so we will skip the IPO section today. And leaving it to Ignacio to do an AI-related deals update.
Okay, thanks, Julia, and hello, everyone. So, sorry, Ray, could we move forward a couple of slides? There you go. All right, so yes, as mentioned, this will be the top-down analysis focused on AI-related deals made in April of 2026, as well as 2026 year-to-date. So jumping into the broader picture here, 2026 has been a very strong year so far, with already $233 billion in total AI investments. Despite only being 4 months in, 2026 is already the highest year on record, having already surpassed 2025's full year total of $223 billion. Zooming in on April here, we saw around 23.5 billion invested across 125 deals, being a relatively strong performing month overall. And in the next slide, we'll see that this performance is largely due to the mega deals. So moving on and zooming in on these mega deals, or deals over 500 million. In April, we saw 3 of these. So first being Anthropic, which as we know is a foundational model. They raised a total of $15 billion. And to note here that in this 15 billion, this comes from a combination of 10 billion raised by Alphabet as a part of their targeted $40 billion of investments. And the remaining 5 billion is raised by Amazon as a part of their targeted $25 billion of investments made towards Anthropic. This suggests that we can expect as much as $50 billion in further Anthropic investments by Alphabet and Amazon alone in the near future. Apart from these, we also have Ineffable, which is as well a foundational model, which raised 1.1 billion in seed funding, led by Lightspeed and Sequoia Capital. Then we have Firamis Technologies, which is an AI infrastructure company, which raised $505 million in venture funding led by Coatue Management. Collectively, these deals have taken up around $16.6 billion in funding, or around 71% of the total AI investments. And on to the next slide, please, Ray. Thank you. So looking beyond these mega deals, we can see that if we exclude these huge outliers such as Anthropic, investments are still picking up overall. In this slide, we can see that April shows a relatively strong performance, though not as strong as recent months, being the 7th highest month since the beginning of this study in 2022, but the lowest performing month of this year so far, with nearly $7 billion invested across the remaining 122 deals. And to go a little bit more in depth here, we can actually continue to the next slide. Thank you. So looking deeper into the segmentation of deals in April, we can look into the 4 segments that received significant investments without the influence of mega deals. So first here, we have hardware, which raised around 1.1 billion across 12 deals. Notably here, we have C5, which raised around $400 million and is a developer of customized semiconductors. Next is Martech, which raised around $930 million across 17 deals. Here, notably, we have Shengshu, which raised around $290 million and is a generative AI platform focused on content creation. Next is Office of the CIO, which raised around $745 million across 19 deals. Here, notably, we have Factory AI, which raised $150 million and is an app development and testing platform. And lastly, we have Healthcare, which raised around $700 million across 18 deals. And here, notably, we have Colteron, which raised $125 million and is an AI native biopharmaceutical company. And onto the next slide, please. So beyond the quantitative analysis, our objective is to do a zoom in on a couple of use cases that we believe are worth having on your radar. Having said that, I'd like to spend some time to talk about the company Sona, which is an AI workforce management company focusing on hospitality, retail, and social care. Sona enables optimized employee communication and staffing on a single platform, with typical use cases such as AI-driven scheduling, shift fill automation, AI-assisted payroll, and manager assistance through a native copilot. Aside from these use cases, Sona of course sets itself apart through AI empowerment, which would help with the likes of demand forecasting, which uses data to predict labor demand, reducing unnecessary and excess staffing, payroll accuracy and compliance, which reduces manual reconciliation and corrections, and as well optimize scheduling, which increases employee retention by balancing skill, availability, and fairness to reduce employee burnout. These AI-empowered solutions are progressively growing and further disrupting the way that traditional workforce management solutions typically operate, which is why we believe that cases like this are interesting and worth having on your radar. Thank you very much. That's it on my end, so I'll give the floor now to Miguel, who will be covering earnings.
Thanks, Ignacio. Next slide, please, Ray. So as mentioned by Julia, no IPO, so B2B software IPO so far. So next slide, Ray. Next, I think two more. Okay, one more. Okay, on this one. Yep, so moving on to the earnings. So 15 companies reported initial earnings covering Q1 of 2026. Out of these companies, their stock price performance is almost a split on positive and negative, despite 13 of them beating consensus. And we've been seeing this as the same narrative from the previous market sessions. And why? We'll find out more on the next slide. So this is a mouthful. So the way we would want to present this is we looked at key themes here. So we've listed some of the highlights on each of the companies, but you can read offline more on these parts. But three key themes we're seeing here, right? So on this cohort of earnings. First theme is I want to highlight the majors. So what majors are actually facing right now is basically this AI capex boom. And what's happening here is that your Amazon, Microsoft, Alphabet, and Meta, they're posting large AI-driven cloud growth while also aggressively scaling their capex to higher levels. Case in point here, Microsoft posted 54 billion US in cloud revenue. It's up 29%, so it's also growing, with its AI business surpassing 37 billion ARR, which is up 123%. Their capex was high, and they continue to expect their 2026 calendar year capex to reach roughly around 190 billion US. Despite this large investment and large and growing investment, their overall headcount is expected to decrease year over year. As they mentioned in the recent company earnings, the company focuses more on the pace and agility, so they would be decrease. There is a anticipated headcount decrease for Microsoft. For Alphabet, their Google Cloud revenue accelerated by 63%, which is really high, to 20 billion US, with their Gen AI product revenue driving a bulk of this growth. And to support this, they raised their full year 2026 capex guidance to 180 to 190 billion US. Same thing for Amazon. Amazon saw AWS growth accelerate again to 28%, hitting this 150 billion US annualized run rate. And then for Meta, they increased their 2026 capex guidance to 125 billion to 145 billion US. And also, their management reported in their recent earnings that they have plans to reduce the size of their employee base this coming May. And this notes a leaner operating model that would help offset these substantial infrastructure investments for them. So basically, what we're seeing here and from previous earnings where majors continue to funnel hundreds of billions into AI infrastructure while also simultaneously shrinking their workforces to fund these capital intensive investments to further drive this operating leverage. A second theme here, so the Middle East conflict, it's both a software headwind and a catalyst. So what I mean by this is this conflict in East is creating this effect across different kinds of software. So case in point, ServiceNow mentioned around 75 basis point headwind to its Q1 subscription revenue growth due to delayed closings of several large sovereign cloud on-premise deals in the Middle East. For SAP, management said the conflict led to some customers to prioritize immediate firefighting, which negatively impacted their first half pipeline and booking starting in mid-March. Hexagon also reported that challenging conditions related to that regional conflict reduced activity and weighed heavily on their geosystem revenue in that region. However, on the other hand, you have Temenos and Tenable driving in this region despite this macro environment. So Tenable, they were able to displace an incumbent to secure a seven-figure deal with a major Middle East financial institution. Same with Temenos. They said there was no visible impact from the war, and they even reported like a strong regional deal signing, such as taking one large bank in Bahrain live on their core platform. Last theme that we're seeing here, specifically on supply chain tech, in the supply chain and commerce software space, what we're seeing is this relying on the third-party marketplace dynamic is proving quite risky versus this unified cloud-native platforms, which is more rewarding for especially for legacy modernization. So an example here is SPS Commerce. They're facing severe growth headwinds right now due to Amazon's revenue recovery business. So their revenue recovery business. Because Amazon recently enacted this policy change that would reduce the amount of money SPS can recover for third-party suppliers. In response to that weakened unit economics, SPS is introducing this new monthly subscription fee that is expected to actually intentionally churn around 4,000 low revenue Amazon suppliers by the end of 2026. On the other hand, you have Manhattan Associates. They delivered strong results with cloud revenue growing 24% because they're capitalizing on companies migrating away from legacy on-premise systems to their they call it unified active platform by unifying this warehouse and transportation management into a single application. And they mentioned they had around of 70% win rate of taking business away from competitors who fail to invest in modern cloud architectures. So these are three key themes we're seeing here. So to sum it up, you have your AI capex boom with the majors, the conflict in Middle East as a headwind and catalyst for several players here, and there's a diverging path here for supply chain on relying on third-party marketplace versus providing this unified cloud-native platform. Those are the three main themes that released just this April, and we'll keep you updated on the next ones. I will now be passing it back to Ben.
Thank you for joining us live today. Hope it was informative and useful. Don't hesitate to get back to us with questions and feedback, and looking forward to seeing you again in the next few weeks. Until then, all the best. Bye-bye.